All right, so let's turn our attention to Chapter 8 as we make our way through the balance sheet. We're going to be looking at receivables. And of course, we have just in our process of studying the accounting cycle and the balance sheet as a whole and how the balance sheet has a relationship with the income statement. We have already touched on receivables, at least to the extent of we've discussed what are called account receivables or accounts receivable. We're going to mostly be talking about accounts receivable in this chapter, but we're also going to introduce some other types of receivables. So let's see here. We've got some learning objectives. We are going to get through probably, yes, all of these. This particular lecture will cover, let's see here, probably the first 3 objectives, and then we'll move on from there. Okay, so as our slide says here, it says the most common transaction creating a receivable is selling merchandise or services on account. And you may recall that we went through the exercise very early on that was related to the accounting equation, and we looked at how assets go up, how assets go down, liabilities up and down, and then the impact on owner's equity. And we said that whenever a sale is made on account, that at that point assets go up, and then later on when we collect that receivable, we reduce the receivable and we increase cash, that there's no change in owner's equity. We had already made that adjustment. Okay, so that is going to be the primary focus of what we're looking at here, but just wanted to give you a quick review. Other information on your slide. Again, this should all be review. When an accounts receivable goes up, we debit that account because assets go up with a debit. Accounts receivable are collected in a short period of time. That makes sense because these are current assets, and then that your slide indicates that as well. Okay, we also want to talk a little bit about what are called notes receivable. And you can have a note receivable that is a current asset or a long-term asset, but for our purposes for this discussion, we are talking about a receivable that is a current asset that is going to be collected fairly soon. Your slide says here periods of more than 60 days, but certainly less than 1 year. Probably the biggest difference between an account receivable and a note receivable is this part right up here, that a note receivable is more formal. There's a written instrument or a contract involved, very, very similar to if you've ever gone and purchased a new car. There's tons and tons of paperwork. Okay, a regular accounts receivable is somewhat less formal. But both of these items, whether we're talking about an accounts receivable or a notes receivable, these are both owner claims to someone else's assets. Okay, I've provided something to you, either in the form of product, services, or in some cases cash, and now my asset that I'm holding is the receivable, either an accounts receivable or note receivable. We also have a few examples here of some other types of receivables. When you file your taxes, and let's say that you graduate college and you go out and you get a job, and let's just say that over the course of the year you pay you have withheld from your paycheck $5,000 in federal income tax, and you do your tax return at the beginning of the next year, and you really should have only paid the government, say, $4,500. And so you submit your tax return, and you get what you have probably heard referred to as a tax refund. But I want you to understand that from December 31st until the time that you filed that tax return, you really had a receivable with the government for $500. You had a claim, you had an asset on your personal balance sheet, so on. Interest receivable, this could be in a variety of settings. This could either be a more formal setting, such as a bank, because when they loan money out, a portion of that is principal, a portion of that is interest. Businesses can do the exact same thing. And then sometimes we will make loans to officers of the company, or we might extend some type of a payroll advance to employees. These are all other types of receivables, and these all have one thing in common. They're going to be collected in less than 1 year. Okay. I said that we were going to cover the first 3 learning objectives. I guess we're actually going to get into learning objective 4. We also have to understand that, and this is kind of common sense, I think, but we also have to understand that sometimes when we extend credit to customers, even though they may have intended to pay us back, they don't always. And so your slide says right here, a major issue of selling merchandise or services on account is that some customers will not pay. Now, you may be wondering, and this is not to get off track here, but you may be wondering, well, why not just avoid that and do cash only? Well, the idea for most businesses is that by extending credit to customers, even though we know that some of those accounts are going to become uncollectible, by extending the credit, we are exponentially increasing our sales rather than if we accepted cash only. And so sometimes there's a trade-off, and we determine that as long as we don't just extend credit to anybody and everybody, we can vastly improve our overall profits if we offer credit to customers, allow them to pay and satisfy their receivables with us. But we do have to, even though that's easy enough to figure out, then we have to say, okay, well, whenever these receivables become uncollectible, we are going to have to deal with that reality. Okay, so see, we've covered the first part of this slide here. When this happens, so I want you to understand, we are talking about receivables. Receivables are on the balance sheet. But when we have a debt that is not paid to us, we are going to have an operating expense. It's an operating expense because we sold merchandise or services in the ordinary course of business, and so whenever whatever receivable we have set up becomes uncollectible, we have what is called bad debt expense. Okay, I prefer the term bad debt expense, particularly for an Accounting 1 class, because we want to make sure that we understand it is an expense. We also have some other little bit more wordy examples. All 3 of these are synonyms, okay? But what we're going to be studying in this chapter is how we go about executing what is essentially referred to as a write-off process, okay? But ultimately, we are going to have some bad debt expense whenever an account receivable or any type of receivable becomes uncollectible. All right, so how do we make this determination? After all, we sold this merchandise on credit. That means that we're not getting the money up front. So some indications that an account may be uncollectible. The due date comes and goes and we don't have our money. Customer ignores us. The customer files for bankruptcy. That's a pretty good indication that our receivable is no longer any good. Customer just simply closes up shop. Could be related to the second item here. And we simply cannot locate the customer. They have left the area and they are, we don't know what's going on with them, but we do know that we haven't received our money. That's the biggest key to all of this. If we don't know where the customer is, but they're still paying us somehow, we don't have an uncollectible receivable. So that's the biggest thing, is that we're not getting paid. Okay, so this is where we get into where we start to complicate things a little bit. We have two methods for writing off these receivables. We have what's called the direct write-off method, and we use this method whenever a company is pretty small and they don't do a lot of business with receivables. They usually accept cash only, but in certain situations they may have some receivables set up. A really good example of that would be an electrician that goes out and makes house calls. So they generally are going to collect 95% of their money at the time of service, but in certain situations they might set up some accounts receivable. The second method, and what we're going to spend most of our time on, is called the allowance method, and this is more for businesses that do primarily all of their business on credit. So if you were to think about a supplier, a wholesaler that sells to retail establishments, that sort of thing, these type businesses almost never get cash up front. They might do that in a handful of situations with a brand new customer who's trying to establish some credit with them, but even then that's fairly rare. And then notice here that the allowance method is a GAAP approved method. It says GAAP requires companies with large amount of receivables to use the allowance method. Okay, so we can use the direct write-off method, but it is used in limited set of circumstances. So we're going to look first at the easier of the two, this direct write-off method. And it says here, assume that a $4,200 account receivable from D.L. Ross has been determined to be uncollectible for any number of reasons. The entry to write off the account is as follows. We simply, because this is the direct write-off method, we say, okay, we have $4,200 receivable. We're not going to get that money. We're going to immediately debit bad debt expense, and it's going to hit the income statement for the full amount, $4,200. And then we're going to go to the receivable, to the subsidiary ledger for this particular customer, and we're going to credit that receivable $4,200. Very, very easy, very, very straightforward. The allowance method is a little bit different. It says here, as the end of its accounting period on December the 31st, Extone Company has an accounts receivable balance of $200,000, and they estimate that a total of $30,000 of these will become uncollectible, in the next year. So they will make this adjusting entry at the end of the year. They will go ahead and they will recognize this $30,000 in bad debt expense right now. And then they will set up an allowance for doubtful accounts. And then you have this uncollectible accounts estimate here. This is a journal entry explanation. So we don't have two items. It's just this allowance for doubtful accounts. I want you to understand this is an estimate. And also read down here at the bottom, it says, since Extone doesn't know which customer accounts will become uncollectible, a contra asset account called allowance for doubtful accounts is credited for the bad debts. So what this is doing is we're adjusting the true value of our accounts receivable. Essentially what we're doing here is we're saying accounts receivable is $200,000, but we're going to offset that with this $30,000 estimate. The $200,000 is not an estimate. These are real accounts receivables. But this $30,000 here, which is about 15%, which is pretty high, this is an estimate so that we would say, remember, we want to present our financial statements fairly to those external users. So we would say that our real value of our accounts receivable net is $170,000. We'll get into that a little bit more soon. Okay, and there we go. I pretty much covered this already. This amount, $170,000, is called the net realizable value, or the net value of the receivables. Okay, so I want you to understand at this point we have $200,000 accounts receivable, and we don't have any indication for sure that any of these debts are no good. Okay, but we're going to assume that we may have an issue in the future. So we're going to do the exact same thing. Well, not the exact same thing, but we're going to do something similar under the allowance method that we would do with the direct write-off method, but it's going to look a little bit different. So let's take a look and see what we have here. It says on January 21 of the following year, John Parker's account of $6,000 is written off as follows. We're going to, remember, we credited this allowance for doubtful accounts for $30,000. Now we're going to debit it. This part of the entry is the exact same. We have to get rid of this specific subsidiary ledger accounts receivable, in this case for John Parker, for $6,000. This makes it goes away. This makes it go all away. He owed us $6,000. After this entry, he owes us $0. And this allowance for doubtful accounts, which was at $30,000, is now at $24,000. It says because this account is based on an estimate, it will normally have a balance at the end of the year. And it says the allowance account will have a credit balance at the end of the year if the write-offs during the period are less than the beginning balance. That makes sense because we set it up with a credit balance. If it still has a credit balance, that means we didn't get all the way through it. So in the case of setting up this account for $30,000, if it has a $2,000 credit balance, that just simply means that we only wrote off $28,000. However, if it has a debit balance, let's say that that X-Tone company, their allowance for doubtful accounts is a $2,000 debit, well, that means that they wrote off $32,000 if it has a debit balance of $2,000. So you can go ahead and review this slide. This is a very, very good slide, and I encourage you to review this. Because the entire key, everything that you're going to be tested on related to uncollectible accounts, is going to require you to understand the difference between these two methods. And that's kind of just the first step. After that, we're going to break this allowance method down even further. So if you're going to have any success in being able to do that, you have to be able to distinguish between the direct write-off method and the allowance method for starters. Okay, we're going to finish this video up and we'll start a new one shortly.